Hi, it's Josh Rubin here with this week's Insider. Today is Friday, October 21st, and we are joined once again by our venerable COO, Mark Chin. Mark, what's going on today?
Well, we're rolling out a bit of an exciting new index that we've created for our insider listeners and watchers and readers. And I think it's going to give everybody a really interesting and unique perspective into the market, and also how to decipher, are we in a buyer's market? Are we in a seller's market? Are we in a balanced market? And this is new stuff, so I think people will enjoy it.
Yeah, I think so, Mark. You came up with a great concept, and that is to look at the relationship of contracts that are signed along with price improvements on a weekly basis and coming up with our own proprietary index.
That's right, Josh. I think for experienced agents, we look at the database and what's happening in it every single day, right? And if once you start to do that, you get a feeling like, oh, there seems to have been a lot more price drops than there used to be. But it was really, really difficult to get at a time series of that data. So you get an idea of like, oh, there were 500 price drops today, but like, is that a lot or a little? Was it more than last week? You only get a sense. There's no real representation of the data. So we went and got that for people. Let's take a look.
And at the same time, as we take a look at this data, keep in mind that the market remains stable, and we are seeing, a pretty good volume of contracts signed. Last week, in fact, we saw 24 contracts signed of $4 million or more, which is indicative of a relatively strong market, and that was one of the strongest weeks in the luxury market in recent months.
That's an interesting point. This data, or rather these data, are market-wide for Manhattan. So what you're calling out is a relative strength in the luxury side of the market, and that's absolutely true. These data do not segment by price, although we could do that in the future. But right now, this is just an overall broader picture of what's going on. So
yeah,
you want to talk about what this is?
Well, this is obviously the top line, or the red line is contract signed going back over the course of the last 2 years. 2021 clearly was a very strong market. And the blue line is price improvements. And so in 2021, in the first quarter of 2022, we saw properties coming on and trading pretty close to their asking price. And as we've gotten on into 2022 with the Fed rate increases, we've seen a slightly wider delta or range between our initial asking prices and ultimate contract prices and subsequent closings. But some of the properties that have come on thinking that they were still in 2021 have had to adjust along the line. And so we've seen an increase in price improvements. And no surprise, there's a correlation there between the Fed raises of 2022, which have obviously happened at a record rate, and those revised prices.
Yeah, that's exactly right. I mean, one of the things about this chart is there's a lot of data on here, right? There's the contract signed, there's the price drops, there's the Fed funds rate hikes, and I just pointed out that at the very beginning of 2022, in this time series, which is beginning of January 2021 to current, the S&P topped out right at the beginning of the year, as everybody knows, and there's a bit of noise here. It looks like there's a trend, but let me show you what our insider index actually looks like. So this makes the data a lot more clear, and it makes the picture of what's going on super simple. So what this is, Josh, is just a ratio of price drops. There's number of price drops divided by the number of contracts signed on a weekly basis going back to the beginning of 2021. And what you see is, for 18 months or so, you see almost more than 4 contracts signed for every price drop. And starting in January of 2022, quarter by quarter, you start to see the ratio of price drops to contracts signed sort of reversing. And as of right now, with the insider index clocking in at just around 2, what that means is for every contract signed, there are 2 price drops. That's a big difference from 4 contracts signed for every price drop. So it's like,
Right.
it really paints a very clear picture here.
And we see a big jump, obviously, in September, and I think that is indicative of properties that had languished on the market over the summer coming back after Labor Day, and volatility picked up substantially in the equity market, which was already highly volatile. But between about August 15th and really October 1st, into last week, in fact, when we saw that big drop, if you remember, there was about a 1,200 point range after the most recent consumer price index print. The market dropped right away, and then it came back as people digested those numbers. But that said, we've seen the biggest rise in the insider index just in the last month or so. And so it seems to have leveled off in the last couple of weeks. But that's definitely an interesting point.
Yeah, let's give people a little bit more color on how to interpret like the number that the insider index is. Let me change slides here, and this is how we interpret it. And it's open to this is not an exact science, but basically, what we're saying is when we see the insider index at 0.5 and below, that means basically there are at least 4 contracts signed for every price drop. So in that zone, 4 contracts signed for every price drop, that means sellers are in control still, right? They're not having
it's a pretty tight market, and and as you said, sellers are in control, and we're seeing properties sell quickly and pretty close to their asking prices. And then as we get into what you call a balanced market, which is a range of about 50 bips, from 50 to 100 bips, you're calling that a balanced market. And then above that, we're starting to get into a buyer's market, which is what we're seeing now. I mean, I really think that there's also a correlation here in inventory levels, and we're not seeing a spike in inventory levels. And over my nearly 30 years, that typically happens when there is a macroeconomic black swan event, like a September 11th, like a Lehman Brothers, a long-term capital, Russian default, those types of things. So I think we really need to keep our eyes on England. My sense is I don't think we're out of the woods, even though the current cabinet has reversed their tax reforms. So things seem to have stabilized. I don't know if that's just a kick the can moment over there, and whether or not that's going to bleed into our market. I also think that we need to keep an eye on the default of Credit Suisse, and what's going to happen in Ukraine, because I don't trust that that's going away anytime soon. And Putin, talk about volatility. From one day to the next, we never know what the guy is truly going to do. We certainly know what he's capable of. And if anybody's been tuning into Chris Cuomo, not that I watch him avidly, but I do follow him on social media, and his most recent broadcast talked about what the worst case scenario is, and it's nothing pretty. But that said, until we see some sort of black swan event in New York City, we're likely to see inventory remain pretty stable. So as long as we see that, I think we're going to be in a reasonably healthy market.
Yeah, and I think that's an interesting point. One of the things that people talk about all the time is where is the supply? Where is the supply? How many apartments on the market? Is it 6,000, 7,000, 8,000, et cetera? And you're right, there hasn't been a huge spike in that supply. The interesting thing for us is to look at price drops, because it's more about sentiment, right? You could have a lot of supply out there and have sellers holding the line on their prices, but when you start to see in the supply that's there, people dropping prices, that shows there's a little bit of fear in the market. And your comment about these extraordinary external events that could be or are happening now, I think that's trickling down into sales psychology. You're seeing it now in the price reductions that we're seeing in the market.
Yeah, I mean, look, sellers are realistic. There are a number of properties out there that have languished, and those we're obviously going to see either price improvements by way of revised asking prices, which is really a reflection of improved expectations on the part of sellers, or those properties are simply going to come off the market because those are people who just don't need to sell. But keep in mind that there are attractive properties coming on that are reasonably priced, well located, and in good condition, and those properties are going to continue to sell regardless of macro uncertainty.
Yeah, let's double click on that point as we end today's insider talk. The truth of the matter is, when the market gets soft, there are still a lot of transactions that happen, right? So there are deals to be had for those buyers, and sellers are often motivated by things other than money. Like, they had a death in the family, they're moving out, they've got relocated, they got married, they had kids. There's all these things that force people to change their living situation. And just because market softening doesn't mean that there isn't good value to be out there on both the buying and selling side, and also transaction volume. So,
but bear in mind, Mark, that we're not really in a soft market. We've been privy to a number of negotiations recently where people would come in, 10 or more % below the asking price, and while the sellers would give a counter that was more of a token close to their asking price that dignified that initial offer with a response, we wound up seeing those properties trade much closer to their asking prices than those buyers had initially considered. So we're not yet seeing these huge spreads between asking prices and selling prices. This presentation is really about improved expectations on the part of sellers and being a little bit more realistic given where the market actually is. So, this has been great, Mark, and I applaud the innovation and perspective on where we are today. So this has been great.
Thanks, Josh, and we'll see everybody next week for the next edition of The Insider. Thank you.
Enjoy the weekend.